Hey everyone, welcome back. In today's class, we are going to explain you everything about stock market. Let's get started. First, what is the stock market? Stock market, also known as the equity market, is a mechanism for buying and selling shares of publicly traded companies. At a macro level, the stock market represents the collective market value of all the company shares traded on a given exchange, while at a micro level, it is the price of a single company's shares. It is operated by a central exchange which acts as an intermediary between buyers and sellers. The primary function of the stock market is to allow investors to invest their money into the companies they own shares of, thereby allowing those companies to raise capital in exchange for a portion of ownership. This enables companies to finance innovation, expansion, and growth. Some of the major stock exchanges include New York Stock Exchange, NASDAQ, Bombay Stock Exchange, National Stock Exchange of India, London Stock Exchange, and Tokyo Stock Exchange. Second, how does the stock market work? A stock or share represents a unit of ownership in a corporation. There are two types of stocks, common and preferred. Preferred stockholders are entitled to a fixed dividend and have a higher claim on the company's assets in the event of liquidation. Common stockholders have no guaranteed dividend, but typically have voting rights and may receive capital gains if the stock price increases. Stocks are traded on a stock exchange where buyers and sellers come together to buy and sell shares. The price of a stock is determined by the interaction of supply and demand. When demand exceeds supply, the price rises. When supply exceeds demand, the price falls. Market makers play a vital role in providing liquidity to the market by placing buy and sell orders. Liquidity refers to the ease with which a stock can be bought or sold without significantly affecting its price. An order is an instruction given by an investor to a broker to buy or sell a stock at a specified price or better. There are four types of orders: market order, limit order, stop order, and stop limit order. A market order is an order to buy or sell a stock at the current market price. A limit order is an order to buy or sell a stock at a specified price or better. A stop order is an order to buy or sell a stock when the stock price reaches a specified level. Stop limit order is an order that combines a stop order with a limit order. Third, who participates in the stock market? There are 5 types of participants in the stock market: retail investors, institutional investors, brokers, market makers, and exchanges. Retail investors are individual investors, such as yourself and me, who invest their own money. Institutional investors are entities such as mutual funds, pension funds, and insurance companies that invest on behalf of their clients. Brokers are intermediaries who execute orders on behalf of investors. Market makers are entities that provide liquidity to the market by placing buy and sell orders. Exchanges are platforms where buyers and sellers come together to trade stocks. Regulators are government agencies that oversee the stock market to protect investors and ensure market integrity. Fourth, what are the different types of market analysis? There are 3 types of market analysis: fundamental analysis, technical analysis, and quantitative analysis. Fundamental analysis involves evaluating a company's financial statements, industry, and economic conditions to determine its intrinsic value. Technical analysis involves studying past price and volume data to identify trends and patterns. Quantitative analysis uses mathematical models and algorithms to analyze market data and generate trading signals. Fifth, what are the different market segments? There are 2 main segments of the market: primary market and secondary market. The primary market is where companies raise capital by issuing new shares to investors. The secondary market is where investors trade existing shares among themselves. In the primary market, there are 2 types of offerings: initial public offering and follow-on offering. An IPO is the first sale of shares to the public by a private company. A follow-on offering is the sale of additional shares by a public company. Sixth, what are the different types of orders and executions? There are several types of orders that can be executed in the stock market. These include a market order, limit order, stop order, trailing stop order, and bracket orders. Each type of order has its own advantages and disadvantages that should be considered before placing an order. Seventh, what are the different stock market cycles in psychology? Stock market goes through various cycles driven by investor psychology. Some of these cycles include bull market, bear market, euphoria, panic, greed, and fear. Understanding these cycles and the psychology behind them can help investors make more informed decisions. A bull market is a market characterized by rising prices and investor optimism, while a bear market is a market characterized by falling prices and investor pessimism. Eighth, what are some of the major historical market crashes? There have been several major market crashes throughout history. Some of these include the Great Depression of the 1930s, the dot-com bubble of the late 1990s, the 2008 financial crisis, and the COVID-19 crash of 2020. Each crash had its own unique causes and consequences. Studying these crashes can provide valuable insights into market behavior and help investors prepare for future crashes. For example, the Great Depression was caused by a combination of factors, including overspeculation, bank failures, and a decline in international trade. The dot-com bubble was caused by the rapid growth of the internet and the belief that all internet-related stocks would rise in price. The 2008 financial crisis was caused by the collapse of the U.S. housing market and the subsequent credit crunch. The COVID-19 crash was caused by the global pandemic and the resulting economic shutdown. Ninth, what are some of the risks of investing in the stock market? Investing in the stock market comes with several risks. These include market risk, liquidity risk, volatility risk, and geopolitical risk. Market risk is the risk that the value of a stock or portfolio will decline due to factors such as changes in investor sentiment or economic conditions. Liquidity risk is the risk that a stock cannot be sold quickly without significantly affecting its price. Volatility risk is the risk that the price of a stock or portfolio will fluctuate significantly, resulting in potential losses. Geopolitical risk is the risk that events such as wars or political instability will affect the value of a stock or portfolio. It's important to understand these risks and take steps to mitigate them. One way to do this is to diversify your investments across different asset classes, industries, and geographic regions. Another way is to invest in a broad index fund, which provides exposure to the entire market rather than just a few individual stocks. 10. What is the difference between long-term investing and short-term trading? Long-term investing involves holding stocks for an extended period of time, typically more than 1 year, with the goal of benefiting from long-term growth. Short-term trading involves buying and selling stocks frequently, with the goal of profiting from short-term price fluctuations. Both investing and trading can be profitable, but they require different strategies, skills, and risk tolerance. Long-term investing is generally considered less risky and more suitable for investors who have a long time horizon and can tolerate short-term fluctuations in the value of their investments. Short-term trading, on the other hand, is more risky and is generally considered more suitable for traders who have a shorter time horizon and are willing to take on more risk. 11. How to start investing in the stock market. Here are the 10 steps on how to start investing in the stock market. Choose a broker. Open a brokerage account. Complete KYC verification. Link your bank account. Make an initial deposit. Select a stock to buy. Place an order to buy the stock. Monitor your investment. Reinvest your earnings and keep learning. 12. Who are the regulatory bodies that oversee the stock market? There are several regulatory bodies that oversee the stock market in different countries. Some of the major ones include the Securities and Exchange Commission in the United States, Securities and Exchange Board of India in India, Financial Conduct Authority in the United Kingdom, Japan's Financial Services Agency, and the Australian Securities and Investments Commission. These organizations are responsible for protecting investors, maintaining market integrity, and ensuring that securities markets are fair and efficient. 13. What are some advanced topics related to the stock market? There are several advanced topics related to the stock market that can be studied to enhance your knowledge and skills. Some of these topics include options, futures, short selling, exchange-traded funds, real estate investment trusts, mutual funds, and more. Each topic has its own unique set of rules, strategies, and risks that should be considered. Thank you for watching this video. We hope that you found it helpful and informative. Remember that this explanation is for educational and informational purposes only and is not financial advice. Consult with a licensed financial advisor or broker before executing trades in live markets. If you have any questions or comments, feel free to drop them below.